Bring that ass back like a boom, 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 boom.
Good morning, everyone. This is Supernova. You're with Boom Traders Weekly Market Overview for the second week of 2023. And what a week we had. So let's get it going. First, we do have the disclaimer basically saying that this video is for educational and information purposes only, and we are not financial advisor. Thus, none of the things that we say here are to be taken as financial recommendations to buy or short sell any securities, and the risk is on your side. As far as session overview goes, there's a slight change here. So first I'm going to start with the models as usual, but then I have the notes, then market price action. There are no internals because I will cover some of those internals in the notes. Then we do have the sentiment, seasonality, and summary at the end. So let's get it going with the market outlook. We do have the short term on positive, although extended, as you will see in just a little while. We do have the midterm on neutral, which is very positive. We are right at the 200-day moving average on the S&P 500, but below very key resistance zones. So I still have the market on negative, you see in the red. If we start consolidating here, so basically we're not immediately rejected, and I think this will be the fifth time that we're going to be trying to jump over this resistance. Well, actually the fourth time, because the first one is the initial pivot. So the fourth time we're going to be battling this and try to move out of it. So if we can consolidate or move out a little bit and then consolidate, then we will switch this to neutral. But for now, the long term and the general market still look bearish. The midterm did move to neutral with the recent move. The overall market model, as I said, on caution. And the breakout model, surprisingly or not, has been working really well for the first 2 weeks of 2023. So it's a really good way to start the year. Now, without further ado, let's go to the notes, and I'll switch the slides and I'll show you something from TradingView. Now, you know I don't use TradingView general, but this is the only place where I was able to find a chart of this ticker that I want to show you. And what you will see here is pretty much a leading indicator of what the market is going to do. And this is the Bank of America High Yield Index. So what you see here with this blue line is the High Yield Index ticker symbol, and right here you can see it. I will also paste it in the description if you want to follow along and you're using TradingView. But this is pretty much a foreteller to how the market is going to move, and you can see it's pretty much mirror image, of course reversed, of the market. However, you can see that, for example, the high yield right here bottomed, and that was until September 21. Basically double bottom right here between July and September 21st, where the market moved a little bit more to the high and then topped over. You can see with the COVID low, this just exploded. You can see right here 2018, and you can play with this, but what you are seeing right now, and I'm not sure that this is the way that you do it. No, you're scrolling. Okay, so you're scrolling to zoom in TradingView, but you can see that it's pretty much mirroring the action of the market for 2022. They crossed. You can see this, the market's making a high, the yields are making a low, and then a high, and then a low. And you can see there's some divergence as well, but what you are seeing right now, that the high yield basically dropped below the November lows, whereas the market still hasn't surpassed that. So we are curling really nice on the market, and this is pretty much a leading indicator that the market is turning to positive signs, regardless of what the Feds are saying or not. So now let's go back to the notes and then switch to the think or swim to see some more of the internals. So one thing that also is worth mentioning here, the 2023 medial to maturity, you can see with the white line right here, there's the bonds. They've basically even out on the top around November last year, whereas the hikes and the Fed rate, you see that with this green line, has been going up, and it's been going up, And the 2024 is already pricing in and dropping in price since November last year. So this is where the market is basically expecting the rates to start turning around. So this is in fact what the bonds have been predicted. I mentioned a couple of weeks ago that the bond traders are already setting up for a pivot in the hikes. But there are a couple of things that I want you to remember, and these are the two mandates that the Fed do have. So as far as the market goes, the Fed are not concerned. So basically, their mandates are two things. Number one is keep inflation relatively low. So the 2% is their threshold, and they try to keep inflation within those boundaries. And the second one is keep unemployment relatively low. So this is what the Feds are structured and mandated to do in terms of what they've been created for ever since the start of last century. The markets in general are not their priority, but given recent developments with all those members of the Congress trading and so forth, I would like to think that there's more of a personal interest involved in their decision-making policy, and with the huge involvement that Wall Street and basically huge money makers and financial institutions have on the policy making in Washington D.C., I'm thinking that the Fed's mandates have been a little bit extended beyond what they were supposed to do initially. Now, I showed this chart in chat, our Discord server, of course, and I noted that there are a couple of things that do bother me a little bit right here, and these is the oversold level, the overbottom, sorry. I keep saying oversold and I mean overbought. So these are the overbought levels of my indicators pointing towards, I wouldn't say a break, but maybe some pause in the action of the price movement. Basically, my point of view right now at this very moment is if you are trying to buy on strength, I would suggest you wait a little bit, see how the market is developing, see if we can get some healthy pullback, because what we've had so far is pretty amazing for start of the year. 2 weeks straight up action right out of this consolidation. We'll look a little bit later on the market price action, but we are extended. And just looking at the oscillators right now, forget the resistance zones right above us. We're going to be talking about that in just a second. But speaking purely from the oscillators, which are based on the advanced decline volume, the advanced decline issues, I have 4 right here. They show pretty much the exact same thing. They're computed pretty much in the same way with some similarities. There are some differences, nuances that you get used to when looking at them, but you can gauge that we are at a point where the market needs a break. It needs rest. We are quite overbought. You can see both my oscillators based on the advanced decline issues and the advanced decline volume are in deep overbought territory. You have the spike breadth thrust and the McLean oscillator, which are also very similar right here. They're basically overbought, both of them. But what is really interesting to see, and let me just do that. So I'll just hide those for you. And we're just gonna go by the first oscillator, the one that I use the most. So this is, we have the NASDAQ composite in white, and we have the purple line, which is the SPX. But look at every single time, and I'll just go back, let's say 5 years. Let's see, 5 years. And let's pick the last, let's do like this because it's easier on the eye. But every single time we've been right here on the green line, and we can put some markers right there. I'll get the drawing to, I need a vertical line. Where's the vertical line? No, that's not it. Trend line, price line. All right, anyway, we can just look at the chart like this. So every single time we've been around these levels, which are the overbought levels, you can see that the market has stopped either immediately or with a very short pause, but right here. So we stopped right here. We've stopped right here. You can say that this is overbought level or touching it. We're not as we are right now above it, but we've certainly touched it. Market rollover, not immediately, but it's a warning sign. We had it right here. You can see from right here, the market started making new highs. This one with the advanced decline issues started making new lows, and then we had a timely pullback, so there was some divergence right here. Next time we almost hit that level, then we followed. This one was right at the bottom, and then you see this was making new lows where the market's making new highs. Then we have this extreme sell-off on another spike right here. Another spike right here, market selling off. Another spike right here, market selling off. In both markets, I'm looking both at the same time. You see the Nasdaq and SPX. We had this rally off, market sold off. We had this, market sold off. So pretty much every time, this seems to be a leading indicator for what's going on in the market. And right here you can see we're making new highs where these oscillator is making new lows. So something's terribly off. And then we drop from 1150 to right around 10,000. That is on the Nasdaq. So you can clearly see that this oscillator, when it's up this high, the market is due for some sort of a correction. So buying on strength right now, I'd say is a very bad proposition just because the market can pull back. I'm not saying it will. It might go for some sideline action, or it might, just keep going slowly up. But at any moment, at any given time, we are due for a pullback. The perfect timing, and we can zoom in. The perfect timing for actually making new purchases is when the market is in a basing structure and this is starting to make highs where the market is still either down, or as in the case with the SPX right here, the purple line, it was making a sideways action right here, whereas this was making new highs. So that's the perfect time when you are buying on strength. Or in case you want to time the reversal in the market, you can start accumulating some positions right here at the bottom of the oversold. Get this one this time right at the oversold levels. But right here in the overbought levels, you can try, but limit your exposure, or at least be worried that the market might want to stall for a bit. Now moving to the other indicators that we're looking at, obviously put call ratio falls down a little bit, 0.97, which is still elevated, to be quite honest with you, still elevated for this type of market that we are experiencing. Of course, we're seeing net new highs, net new lows, and I do have the zero line here, but the other zero line is right here for the SPX. So anyway, looking at the readings, both are, one is at 111 and SPX at 103, so making new highs clearly. As far as VIX is concerned, we have dropped below 18. I think we made, the low was 1801, but we dropped very, very low. And you can see that we are below this trend line that I've outlined earlier in the year, below the 20 zone. So clearly VIX is confirming the price action in the market. Now, one thing that I mentioned in chat, if you look at the up-down volume, this is the up-down volume. These four are New York Stock Exchange, Nasdaq, Russell, and Dow Jones. You can see that the up-down volume has been actually dropping. I mean, it's positive, that's for sure, but it has been dropping, and you can see that the Russell on Friday, the up-down volume was very, very slim. So despite the strong action price-wise, the internals are starting to deteriorate and slowing down the pace, which is another clue that I'm getting that this market might actually need some break right now from the two wild weeks that we did have. As far as the companies above their 50-day moving average here on the S&P 500, you can see we are still not quite overbought, 0.8 as far as the level goes, but this is certainly an elevated level. 76 percent of stocks in the S&P 500 are above their 50-day moving average, and you can see this is the start of 2022. We've had only 3 spikes above it. So one was the initial spike, 4th and 5th of January. of 2022, and then we have one in August, and we had one in at the end of November, beginning of December, and now we're looking to pretty much same spot. As far as the stocks above their 200-day moving average, again on the S&P 500, you can see we are almost at the highs right here from the end of November and beginning of December. 62% of stocks right now are above their 200-day moving average. So clearly, I think that we do have some. I think that we do have some things to worry about here after 2 fantastic weeks. Now let's take a look at the price action, and I think that we will have some things to talk about because the market is positioned to basically have a collision with some resistance zones. So on to market price action, starting with the S&P 500. I also shared this chart in our chat group. You can see what is worrying me here is that volume is coming down. So it's on a downtrend ever since we got this sell-off right here. This was a huge megathon pattern right here. Mentioned it as well in chat. It was a very good sell signal right here. Some people made money off of it. But what is happening right now, we are right below this resistance line, hitting it approximately right here at the 400 mark. We do have the 200-day moving average right above us, or I think we actually were able to close above it. You can see the 200-day moving average is at 406. No, so we, is it at 406? Simple day, yep. As far as I see on the chart, it says 404. Although it looks, it's a little bit low right here. It looks at 397.201. So yeah, 397.21. So we closed above the 200-day moving average. But look at the volume on this last candle compared to the volume in this candle right here. When we tapped the 200-day, were rejected, and we blasted through it on lower volume. So I do have a feeling, I'm looking at the chart, and I do have a feeling that something's really off right here, and we might see some pullback, which will actually be very healthy. But when I was talking about the oscillators and they're making new highs as far as the advanced decline issues, and we are in this consolidation area right below the 50, this day right here, the follow through day right here, was the place to buy. So that was last Friday, well, a week from last Friday. That was the time to buy and to actually step up for some leaders if you were willing to buy and see where it takes you. Right now we have this key level of 396 for the S&P 500. We do have this resistance on top. We do have the 200-day moving average right around here, and we do have this COVID low. And let me just look at 5-year 1 day so you see what I'm talking about. So from the COVID low, touching this low and touching this low, but right now we're talking about this low right here, touching this low. You can see you're now forming some resistance with the up resistance coming from the tops. As far as QQQ is concerned, pretty much the exact same thing. You can see we're still not to this zone right here, about 287-ish, 88, but we do have some solid zone right here, 281, which has been very key in terms of volume point of control, and we still need to move above in order to get to the 200-day moving average. We'll also get to this high right here. So 200-day moving average is coming at about 395. Before that, we do have this one right here from the resistance coming from the top at around 288. So I think this is the first stopping place right here. 288 it's been acting as rejection point a couple of times, so I don't see a reason why it will not act again. And last but not least, volume. I still think we need stronger volume coming off this consolidation here at the bottom. We did have a nice day right here, but you can see that the only time where we actually got stronger volume than the average 20-day volume, the candle was not so positive. So QQQ still looking shaky to me, to say at least. As far as IWM, I showed you it's high above the 200-day moving average. We do have some resistance right here, and obviously this double top actually it seems like a triple top with this one. We just put a line right here so you know where it is. I did properties show on the right. So we do have 189, 190 zone. Definitely some resistance from these triple top. But what is really bothering me here is the fact that volume first is lower on this rise up here, and as we looked on the internals, let me just see if I can restore sell. So if we are looking at the internals for the up down volume and the Russell, you can see here on Friday, despite the price action, very low. You can also see the advanced decline issues compared to the previous 3 days. It's been low, and the moving average at the back, this orange line, is coming back a little bit, which is really, I don't really like this. And also, of course, you have to have this in perspective. We've been up like say like 7, 8 out of 10 days, so that's quite unusual. And I think that we might need to see some break right here. So again, as I said, we looking at the internals and look at where the market price action is. Buying on strength right now, I don't think it's a great idea. Now let's move on with our presentation and go for the sentiment. Not really a surprise. We jumped almost 20 points. As you last week when we reported this, we were at 47. Now we're 63. So 16 points from, I think it was in the fear zone. Well, actually it says neutral, but I had it on 43 at some point. So between the fear and the neutral zone, now we jump to greed. And as far as fear and greed index and Bitcoin, generating cryptocurrencies, we had this huge spike. So Bitcoin surpassed 21,000, Ethereum went almost 1.6k. So overall, a very good week. Both Bitcoin and Ethereum are at pre-FTX crisis levels. So I hope you took my advice when I said 110, 112, 120 was a bottom for Ethereum. I hope you got some. Seasonality wise, January is definitely not a good month for the markets, but of course we also do have third year in the presidential cycle, which is actually the best year for the market, so I'm not going to spend much time on that. Again, be careful. I would pay more attention to market price action and volume right here, these zones. In summary, careful, some major resistance zone above us, so the models are on caution for the midterm, positive for short term, but overall we're still on a negative market conditions. So there are some setups. I will post them in chat, but I don't plan on buying anything on strength as I mentioned. The market caution right here, major resistance is mentioned right here, and of course put volume and put volume in terms of the put call ratio, and volatility in terms of the VIX is decreasing. As far as some concerns, of course, recession, Fed hikes, or the pivot point in Fed hikes. We still have the war between Russia and Ukraine going on. More and more funds are drawn into this conflict, so this is a potential problem for the involved parties. But in general, I think that the markets are getting used to this new situation we are in, and people are pivoting into this volatile environment we're trading in. So getting the hang of it. So this is what I have for you this week. I do hope it's beneficial for your trading. Again, probably the major takeoff from this video is just be careful buying on strength right now into the zone. And if you find this beneficial for your trading, I really hope that you give us a thumbs up, subscribe to these videos, turn the notifications on so you're not missing more of the videos that we upload. And of course, join us in Discord where we have an amazing community of traders. Get some ideas, make money. That's what we are in for at the end of the day, right? So I'll see you next week. Have a good one. Bye-bye.